Donald Trump is set to announce global reciprocal tariffs later today, but they may not go into effect until April. So US stocks rose and the US dollar fell. US inflation data is benign. Japan's producer price data supports another Bank of Japan hike, and the Philippine Central Bank unexpectedly holds rates. That's coming up in our 5 Things in 5 Minutes on Friday, February the 14th. And then in today's bonus deep dive interview, ANZ senior economist Miles Workman explains the importance of New Zealand's closely watched inflation expectations survey ahead of next week's live rates decision by the Reserve Bank of New Zealand.
The signal in the data is, do the participants, the forecasters who fill this survey in, do they believe the Reserve Bank is going to do its job?
But first, in 5 and 5 with ANZ, Donald Trump is set to announce global reciprocal tariffs later today. But there's reporting that they may not go into effect until the 1st of April, leaving time for Trump to negotiate country by country and tariff by tariff deals. That saw US stocks rise around 0.5%. Hopes the tariff delays would help soften the inflationary effect saw the 10-year US Treasury yield fall 9 basis points to 4.53%. Here's ANZ economist Bansi Madhavani on those tariffs and how markets reacted.
Reciprocal tariffs essentially would entail that US increases duties on imports from countries that themselves impose higher duties on US goods. The details of tariffs are quite unclear at this point, and going by media reports, they suggest that it will take a few months for these tariffs to come into effect, possibly from the 1st of April. Now, that date coincides with the date when the administration expects to review its trade policy. In terms of market reaction, the prospect of delayed tariff implementation and the expectation that reciprocal tariffs will keep the door open for negotiation, that supported financial market sentiment.
As of 4 a.m. Sydney Melbourne time, the US dollar index was down 0.5%, the Aussie dollar was up 0.1% at 62.92 US cents, while the Kiwi was up 0.2% at 56.53 US cents. Number 2, the UK economy dodged a recession at the end of 2024 with growth of 0.1% in the December quarter, up from a flat Q3. ANZ economist Bansi Madhavani says it does offer some comfort that stagflation is not so close, but the Bank of England is likely to keep cutting.
Despite this slight upside in growth, GDP continues to remain far below its potential, and that implies that cutting rates will remain appropriate as long as inflation cools.
Number 3, Hong Kong's Hang Seng Equity Index has performed strongly in recent sessions, buoyed by news of a leading EV battery maker's plans to list and AI-linked strength. While the index finished yesterday down 0.69% due to profit-taking, this came after its tech stocks hit a 3-year intraday high. ANZ Chief Economist for Greater China, Raymond Yung, says the rally is cause for wider optimism.
The rally started from the middle of January before the Chinese New Year holiday, when the PBOC Governor Pan Gongsheng pledges to increase the allocation of reserve to Hong Kong assets. In addition, there has been a lot of good news from the tech company in China, and some of the tech company has their stock price reaching the highest level since 2022. Overall, the optimism in China seems to have improved, and the sentiment has greatly improved.
Number 4, the Philippine Central Bank unexpectedly held its benchmark rate at 5.75% yesterday, citing global uncertainties as the reason for the pause in a cutting cycle. However, ANZ economist Arindam Chakraborty points out the BSP did signal rate cuts will likely resume in April, while a large cut to bank reserve requirements ratios is also on the cards. Arindam details why the rates were paused for now.
The central bank highlighted the ongoing global trade policy uncertainty as the main hurdle to a rate cut, despite inflation remaining well within the official target range over the past couple of months. Nonetheless, the BSP now views the risks to inflation as broadly balanced. Upside pressures from higher electricity tariffs are expected to be counterbalanced by lower food inflation and more specifically by lower rice prices.
Number 5, Japan's goods producer price inflation continued to rise in January, up 4.2% from a year ago versus expectations for 4%. ANZ FX analyst Felix Ryan says the number is the latest in a series of events pointing to further rate hikes, including strong wage growth last week.
It's just another data point really supportive of the Bank of Japan continuing their policy normalization. So we still see the Bank of Japan reaching 1% by the end of this year.
Felix Ryan there. Now, in today's deep dive interview, ANZ senior economist Miles Workman explains the importance of the Reserve Bank of New Zealand's Inflation Expectations Survey. The Q1 survey out yesterday showed 1 and 2 year expectations down around the middle of the Reserve Bank's 1 to 3% CPI target band.
The main piece of information for the Reserve Bank in these data really comes down to that question as to whether or not respondents of this survey think inflation is going to remain anchored around the 2% target over the medium term. So naturally that makes the 2-year ahead measure, the 5-year ahead measure, even the 10-year ahead measure are quite important indicators for the RBNZ. And the good news for them is that data suggests inflation expectations are indeed anchored near the 2% target midpoint over the medium term. So we can conclude from that these data on their own, they shouldn't really have much influence really over the Reserve Bank's decision next week when it meets on Wednesday. It appears that inflation expectations are where they want them to be, which shouldn't therefore present any roadblocks to whatever decision they want to make. There was one little interesting piece of information in this data in the sense that the 1 year out measure for inflation expectations, that one actually lifted slightly, but that's actually pretty much in line with our own recent forecast tweaks. The New Zealand dollar, of course, has been quite weak towards the end of last year and going into 2025. And of course, that's going to flow through to a little bit more tradable inflation than otherwise, at least temporarily. Now, we all know the Reserve Bank looks through temporary fluctuations in tradable prices, because if they didn't do that, they would be making policy mistakes all the time. But it does show that, yes, expectations for 1 year out a little bit higher because of some of these New Zealand dollar dynamics. But the key message here is, despite that, the longer term measures are still well anchored around 2%. So keep calm and carry on as far as these data go.
Inflation expectations did see that spike as inflation rose, I guess, during COVID. What's led them to come down? Is it just people seeing lower inflation, or is it the more general framing of the economic slump, or reductions in government spending and jobs, or is it mainly just what people see?
Yeah, well, you got to remember what the survey is. It's essentially a survey of about 40 or so professional forecasters and business leaders, I think is what they describe it in the survey notes. And ultimately, for the Reserve Bank, the signal in the data is, do the participants, the forecasters who fill this survey in, do they believe the Reserve Bank is going to do its job? And the Reserve Bank has a 2% inflation target over the medium term, and I think they are a very credible central bank as far as central banks go. So I think it's a very high bar to really push those longer term expectations sort of outside of that 2% range. And when that does happen, it typically has been when there's been very severe shocks that perhaps the Reserve Bank may be perceived it isn't reacting swift enough to, but that's certainly not the environment that we're in right now. But I think if you do think about what the survey actually is, it is largely just a consensus survey on forecasters. And for the Reserve Bank, the key message in it is, do these forecasters believe we're going to do our job, yes or no? And if not, maybe they've got something to worry about. But right now, there's certainly no red flashing lights.
It is a well-watched survey, one of the most well-watched in the country, I guess, in terms of these kind of statistics. Can you think of times in the past where it's thrown a curveball and led to certain decisions by the central bank or moving interest rates?
I think through the COVID era, we did see, if you cast your mind back to the team transitory versus team persistent when we were talking about inflation risks. And I think the key thing for the survey is the Reserve Bank can always tolerate a little bit of near-term inflation pressures, provided it's driven by temporary factors and isn't expected to be a source of persistent inflation that's going to push inflation above the 2% target over the medium term. So when you get an upside surprise in actual inflation, they're going to be quite happy in all likelihood to tolerate 1 year ahead inflation expectations lifting. But what we saw through that COVID period, part of the arguments to pull people away from team transitory was the fact that these longer term measures started to rise as well, suggesting that people were just losing faith that inflation expectations were indeed anchored, and losing faith that perhaps this higher inflation world was a transitory story. We all know that since then, inflation has come down. It's back near the middle of the target band, which is very good news, but it's certainly been a wild ride through that COVID era.
Miles Workman there, speaking to my colleague Alex Tarrant. I'm Bernard Hickey. That was 5 and 5 with ANZ for Friday, February the 14th. Catch you next week with live rates decisions in Australia and New Zealand. This podcast contains general information only, not investment advice. You should obtain advice for your personal circumstances before making any investment decisions. Please view the podcast disclaimer available via your media player or email.